you just heard our Oscar Williams-Grew talk about how the Delta variant spread in the UK is really stymieing the opening efforts there. Here in the US, we are seeing it, but in particular in certain geographic areas, some southern and Midwestern states, even sort of micro areas in the New York metro area, like Staten Island, for example, have seen an uptick in cases. Meghan Fitzgerald is with us now. She's got a lot of titles. She's a private equity investor. She's the author of Ascending Davos, and she's a healthcare policy professor at Columbia University, among other things. Meg, what's your take on how things could unfold here and what effect it could potentially have on the efforts to reopen the economy in the U.S.?
Yeah, nice to see you. So listen, about 4 or 5 states are driving most of the new cases, and the story is pretty conclusive that those that are unvaccinated are going to the hospital and those that are unvaccinated are in the pool of individuals that are dying. So the story is pretty compelling now. We have a lot of data to say you should be vaccinated if you want to ward off going to the hospital and potentially having life-threatening complications. That's really the story. But in these few states, it's problematic, and in areas where you're starting to see surges, really public health officials have no choice but to start to enforce, as we're seeing in LA, mask mandates. I don't think we'll go to hard lockdowns because I'm unsure the majority of people will tolerate it, especially those that are vaccinated. But as you read in my op-ed this weekend, the vice grip is starting to come down on those that are not vaccinated, meaning you're not going to be able to go into certain concerts, certain cruises, and certain clubs unless you have a vaccination.
And Meg, on that point, we've kind of, there was a lot of hype ahead of this mass vaccination wave that, vaccine card that's, sitting in the closet upstairs would be used. People would want to see it and it would be useful for things. And that basically hasn't played out at all anywhere. I mean, is there an appetite for it? What are the steps that need to be taken for that to actually be enforced in some kind of credible way? Because we kind of got to June and it was like, okay, 50, 60%. And then it was sort of a free for all. And here we are 6 weeks later.
I think it's really hard without an electronic vaccine passport. And there's really no political appetite on both sides, by the way, to do this. There's a lot of people that said I got vaccinated. There's also a lot of people honest to tell you they haven't been vaccinated. And so I think people are very honest to say, I'm not vaccinated, and here's my reasons why. And I think, for me, that's the group we really have to target. There's 90 million people that are right now eligible to get vaccinated. And I think that's the group to target because, as you know, that piece of paper could be scanned, it could be copied. You're really going on the honor system to prove that someone's vaccinated. We also don't know what your level of immunity is. We have people that are now thinking, do I need more immunity? How much immunity do I have? And there's going to be a lot of data coming out on not the duration of the immunity, but also the quality of the immunity. So in the meantime, it really, to your point, is the honor system, and that's what we're left with.
Yeah, the honor system, not necessarily very reliable. I mean, when you're in a crowded place, you look around you, you don't know who's vaccinated. You're not going to go around and query people. Egg, you mentioned all those people who are still unvaccinated, and we were talking earlier about the role of social media in all of this. I mean, that's really the conundrum, right? How do you convince those people to get vaccinated when many of them have been convinced by social media and otherwise that they shouldn't?
Yeah. Well, listen, there's a powerful force, and data came out this weekend from the Kaiser Family Foundation that showed in January, they polled a group of people that said, I'm absolutely not getting vaccinated. They re-polled them recently, and a whole raft of them moved off the dime to get vaccinated. And the reasons they gave why are actually really important. One, they trust someone local, someone like me, who's a public health professor, or their physician. They trust that a family member got vaccinated. So it looks like the local advocate wins the day. Second, they don't want to keep hearing that they're going to die of COVID. What they want to hear is that the vaccine is safe. So they're looking to see that, hey, my sister got vaccinated, nothing happened to her. My neighbors got vaccinated, nothing happened to them. So I think we really have to work on the messaging that is positive and that can influence these individuals. With that said, I have a boatload of friends that have read things on Facebook that we have tracking devices in the vaccine, not true, and other things. And it's really hard to combat that. I spend most of my time talking to patients and friends to say, listen, tell me why you don't want to do this. And then I kind of have to refute with data and undo what they may have read somewhere else. So it's certainly a big obstacle for those of us in public health to have people roll into the ER and start talking about some things that are not true. And we have to spend the extra time to convert them. But I'm letting people know that it's worth it. There are a group of people that simply just wanted to know longer term safety data and that it was okay to get this. And they were waiting to see what that real world evidence was. And that's fair.
Yeah, I mean, fluoride conspiracy theories are still sticking around now, decades and decades later. So we know these things can be powerful. I want to switch gears and talk about there's the one part of your brain that's still thinking about COVID, and then there's the other part that's thinking about everything else and all of the other sort of healthcare investing opportunities right now. One company in which you are an investor that is sort of a weight loss management company just announced it's going to be going public through a SPAC deal. Where are we in that cycle, right? In the sort of PE cycle and PE to SPAC cycle as well?
Yeah, interesting. Yeah. So I tend to invest. I consider myself a public health investor. I know that's rare. You may not have a lot of people on the show that say that's what they do, but I look for things that are important. So Gelesis and the product Plenity is to target obesity. And we know from, the reporting on your show and the data that obesity got more concerning during the pandemic. In fact, 42% of the adult population is obese. Think about that for a second. Not overweight, but obese. And so a company like Plenity, the product from Gelesis, partnered with Ro, a telehealth company, to target people not only with a product that is safe and efficacious, but also looking at the patient holistically to make sure that they focus on nutrition and exercising and really go after this. So I think that's an exciting time. It did go out today via SPAC, so you're very timely with the question. And I think where we are with SPACs is it's becoming an instrument that's of interest to owners of businesses and CEOs because it has a benefit, an economic benefit, and it has a speed to market benefit. So I was looking at some of your reporting. 2014, there was like a handful of SPACs, I think 12. And today we're looking at SPACs. There's over 250. Not all SPACs are equal, but I think it's becoming an instrument of choice for some that feel very close to investors and really trust the people that they're investing with, that they can get the SPAC out the door and that it could be something that's an advantage for them.
And do you feel like in the private equity world that it has felt like over the past year there's been so much cash that is just looking for a home? Do you still feel like that we're in that spot and that there are enough interesting, public health opportunities out there, for example?
Yeah, I mean, the market's been on a tear for the last year. So there was, the saying, a year ago, last spring, you could throw a dart at the board and almost all the stocks, if you picked, went up. That's not the case anymore. If you're in private equity, there is a lot of cash on the sidelines. You have to be really convinced of the story. You have to be a differentiated buyer and really believe in your diligence. So for me, I focus a lot in biotech and biopharma services. I'm very bullish on innovation and where the market is going. And also, there's just been a lot of interest in it with COVID. A lot of people realize what biopharma can do. There was a big CDMO deal announced today by partners, I think nearly a $2 billion deal to buy a CDMO to help with drug development. You saw the Thermo Fisher PPD deal earlier this year. So I tend to like things that I know really well, and that for me, I have an advantage because I have a history in doing that. And so I think you're going to see a lot of private equity kind of focus on what they're good at and stay to their knitting. I don't think you're going to see a lot of wildly speculative bets thinking it doesn't matter, the market's going to go up. I don't think people feel that way anymore. I think you're going to see some very discerning buyers.
Interesting. On this day that maybe is a tipping point in the public equity market too. Meghan, always good to see you. Meghan Fitzgerald is a PE investor, author of Ascending Davos, and a healthcare policy professor at Columbia. Great to see you, Meg. Thank you.
All right. Feels good to be in the flight suit.
Oh boy, you guys look great.
Welcome, astronauts, to Launch Site 1 and welcome to the Astronaut Training Center. This capsule is the RTS Tortoise. It is a full-scale mock-up. How you guys feeling?
I have
Good.
I literally have had goosebumps since I stepped in. Like, they haven't gone away.
Amazon founder Jeff Bezos, along with his crew there, preparing to go to space tomorrow. Jeff Bezos, of course, carrying out his childhood dream, traveling to the edge of space aboard Blue Origin's New Shepard tomorrow with 3 other crew members. They're going to be making history in the process with the youngest and oldest passengers aboard to travel to space, along with Bezos' brother. For more on the journey, let's bring in Dylan Taylor, Voyager Space Chairman and CEO. And Dylan, we should point out, you've got a lot of eyes on this one, largely because you're one of the most active private space investors. So much of this has been sort of, there's a lot of cynicism going into this, let's say. A lot of talk about these billionaires that are traveling when so much of these trips are not accessible to sort of the everyday person. How are you viewing what's about to play out tomorrow?
Yeah, I see it differently,
as you might expect. I mean, I think, look, we live in a world that's a little off kilter, I think it's safe to say. And my view is we lack inspiration, we lack vision, we lack hope. And if space isn't the most visionary, inspirational, hopeful thing that we have as a human activity, I don't know what is. So I think, looking at Jeff and Richard and other people who have been uber successful, kind of live their best life and go live out their dreams. I mean, I don't know what more we could do to inspire young people to reach for the stars. I mean, literally and figuratively. So I understand we have an income inequality debate, raging in the US and elsewhere. I think it's an important debate to have, but to me, to attach it to the space race is misguided.
From an inspiration perspective, I guess it's always been interesting to watch it play out in kind of the way that space travel, maybe hasn't looked as realistic to a lot of people as, it had in the past. And kind of with SpaceX and the excitement that company created around it was more focused on, kind of the enterprise side of the business. I mean, you're an investor in the space. What to you maybe has changed over the last few years, and especially now over the last few weeks, as we saw Richard Branson go up, now Jeff Bezos, around maybe shifting away from maybe some of those enterprise-focused companies to now just on space travel? I mean, what does the investing landscape look like now as the future kind of unfolds?
Well, I think more retail investors
will get involved in space. I think there'll be more opportunities for that. But you asked what changed. It was rocket reusability is what's changed. The fact that we can rapidly reuse booster rockets not only has unlocked our ability to get satellites to orbit, and this has been the massive success SpaceX has had, but it also has cracked the code on space tourism, because the ability to reuse the booster rocket in the case of Blue Origin is what's going to bring that ticket price way down from hundreds of thousands of dollars to eventually probably the cost of a really nice vacation. So I think that's really what's changed. And I think as more retail investors get involved, we'll have more opportunities for those investors not only to invest, but to participate in space, maybe even go to space themselves or know people who go to space. So I think space will be a narrative that's increasing in the retail investor's mind. And I think that's a good thing. I think that's an inspirational, motivational thing.
Beyond space tourism, though, what exactly do these dueling missions mean for space exploration? I mean, going beyond the spectacle of Richard Branson and Jeff Bezos going to the edge of space, right. What are the other tangible benefits that you see in terms of the overall space?
Well, I think it's going to be about destinations. So once you're on a path, once we've sort of cracked suborbital rockets and going to the edge of space, it's going to be about where do we go to next. So this will be private space stations. This will be things like the moon eventually, and even Mars and deep space. So I think if the last 10 years was about building access to space and rocket reusability, I think the next 10 years will be about destinations. And then certainly when it comes to ones and zeros, so constellations going up, hardware and satellites in orbit, that's a huge narrative for space investment. We only downlink about 6% of the data we generate in space. So as we build systems to get more data down and marry that with things like AI, machine learning, and predictive analytics, I think there'll be massive value created here on Earth for global commerce based upon space-based data. So those are two themes, destinations and space-based data, that I think will really set the stage for investment going forward.
And Dylan, just to bring it back to what we're going to be seeing tomorrow play out, I mean, obviously it was a long road for Blue Origin to get here, a long road for Jeff Bezos, had to step up kind of the investment to get the company maybe caught back up closer to what SpaceX has been able to do. And then, of course, had Richard Branson, to a certain degree, steal the thunder by swooping in and getting up there early. I mean, what do you make of the strides that Jeff Bezos and Blue Origin have been able to make as of late to try and close the gap there with SpaceX, and how much more money you think it's going to take for them to keep building on what they're going to accomplish tomorrow?
Well, I think Jeff is very ambitious. So he's thinking about infrastructure in space, millions of people living and working in space. But Jeff is also very much a measure twice, cut once person. That's the way he built Amazon. Slow and steady wins the race. If you look at Amazon, it was all about building logistics. And once they had cracked the logistics supply chain issue, then they had superior scale. And that's when they overtook Walmart and Costco and everybody else. So I think space will be very similar. I think he's playing the long game. I think he's focused on heavy lift rockets. He's focused on space-based infrastructure. And he happens to be the richest guy in the world as well, so that always helps. So I wouldn't bet against Jeff.
Dylan, in many ways, what we're seeing play out this month is kind of the culmination of the sea change we've seen in space investment, with the government agencies, particularly NASA, really getting a pullback in funding, and then the private side taking the leadership on that front. Is that going to continue to drive space exploration moving forward? Or you think, on the government, with NASA, for example, the federal government sees what's happening on the private side and say, well, maybe we need to beef up our investments on this side too?
Yeah, I think the government will continue to be a major customer, not only the US, but other space agencies around the world. But even within the US government, it's primarily Department of Defense that's really spending the real money. NASA has resources, of course, but the whole theme, rise of China, hypersonics, that's really driving a lot of the space-based investment. And then, as you alluded to, commercial space. So these are private companies doing business with other private companies. That's probably the fastest growing segment of the market. So as these high growth companies raise money, they need to deploy that to build capability and to hire other companies to do work for them. So that's a big part of the ecosystem going forward.
Bed Bath & Beyond has given a major facelift to one of its most important stores. The home goods retailer is set to reopen its flagship store in New York City on Thursday. Consumers that come by for a visit at the 92,000 square foot location will be greeted by an entirely new vibe for the brand. I got a behind the scenes look at the revamped store with Bed Bath & Beyond CEO Mark Tritton.
In this store, in this space for 30 years, servicing Chelsea, servicing New York with both local residents and tri-states and tourists. So this is an important landmark destination and in a landmark building. So in our 50th year, we remodeled the store. We started talking about it in December. We began our plans, COVID hit. We still believe in New York. We still believe in this space. We continued. So it's an iterative process. We closed the store in December 31st at the end of 2020. And then we spent the last 6-7 months remodeling. So here we are.
You spent time, you're an executive at Nordstrom, executive at Target. What is Mark Tritton, what did you think about when you walked into the store? You haven't seen a remodel really in 30 plus years. How do you go upon redesigning it?
I think it's about the customer experience and the customer journey of who we want to be and what is the easy evolution of the business. And I think that the store we inherited here was incredible. It was large, but it was a pretty daunting experience, if I can call it that. It was more like a warehouse.
You put it nicely.
Yeah. Well, everyone remembers it. It was dark. It was jam-packed with merchandise. It was kind of a bit of a bazaar. And that was fun, but it really wasn't standing for the brand that we wanted to create. So really thinking about how to modernize the experience, and that starts with creating an omni-channel experience here in the store. So it's about the physical and the digital merging, but let's celebrate the home. Let's make home happier and celebrate rooms, categories that we dominate and that customer expect from us. Behind us here, an incredible bath area like you'll see nowhere else in New York. Bed, kitchen, storage and org, health and beauty, indoor decor. This store has it all. And the physicality of everything from the lighting to the floors, to the fixtures, to the layout and the details, much more residential, much more modern. And so customers are able to envisage themselves in their own homes as opposed to shopping off shelf and then trying to work it out later.
Where did the racks go? I walked in here, I stood, one end of the store and I saw the other end of the store.
Yes.
Bed Bath & Beyond, known for their really high racks and you can't see anything.
No, well, this really, 92,000 square feet is a lot. Opening it up and having sight lines from front to back and creating that sense of discovery in a store was really important. So light, bright, fresh, great signage, great value signage, but experiential shopping. And I think that people are so hungry to look and touch and feel and kind of just wander and find things in store, and we really wanted to play off that.
There are a couple different elements in here. You have a SodaStream shop.
Yes.
You have buy online, pick up at the front of the store. You have scan and go. What are some of the other innovations?
I think that the Omni stuff is really important, that you can take out your phone and you can literally shop and scan or use it as a map. Or we have a great coffee shop. You can stop and have a great cup of coffee here. You can actually check the menu on your own phone beforehand if you want. But we've got things like, Nespresso, as you said, SodaStream. We've got a really cool innovation in our vacuum areas. So I've worked with vacuum cleaners for a long time, and customers always say, I can't take that off the rack. I can get the box easily, but what am I actually buying? And it's a big ticket item. We actually have an experience space, carpet, dirt, and great vacuum cleaner assortment. You can pick them up, they're plugged in. You can see what's the weight of this, what's the power of this.
I'm going to try this out.
I know, it's super cool. But I think this idea of more experiential and more in-home expectations of how a customer shops and wants to iterate with the product is really important. I think coming down here, we have the Casper shop. You can lie on a bed. You can test
part of a new deal. You just struck a new deal with Casper.
Absolutely. I think the first ever major in-store presentation in the US. Think about bed, think about sleep, think about us, and think about Casper. It's a natural progression. So here we have a full assortment of Casper, but it's also experiential. Pillows, pet beds, mattresses, you name it. So the idea that you can come in, you can touch, you can feel, and you can experience and find that easily and navigate and discover in the store is really important to us.
92,000 square feet. I imagine to lease the store is not cheap.
No.
Why are you so confident New York comes back?
We never doubted it. We really didn't. I think that it's not a vanity project. It's not about we have to have this flagship to kind of put a stake in the ground like a castle and like a lot of retailers used to do. We have a thriving business here in New York. We have a thriving Chelsea business. We have a thriving New York business.
So you have 4 stores. With this, you have, 3 other stores?
Yes, we have Tribeca, we have Lincoln Center, we have Kips Bay and the store here, and we'll look at the total real estate across New York over time. But this for us was a landmark store for our customer and for the space. I think the area of 6th Avenue we're in is definitely home orientated. It's a great destination space. Whether you're a college student or an apartment dweller, this is the place to come. So we wanted to be here.
How much will this store make in terms of sales in a year?
There's the surprise. I would say to you, it runs, 5 to 7 times our average suburban store. It's that big. And so there was a revenue hit there, but it has to be profitable. It has to make money. And that's what we've been focused on all the way in. So we will have maybe a few more of these across the country in the right markets where we have the right real estate, where we can fully express the ultimate expression of the brand, like a hub and a spoke, but there won't be anything like Chelsea.
So you are also remodeling, 450 stores. What components from this store will be in those stores?
Yeah, look, I think this is really emblematic of the 450 stores we're going to remodel. We've already started that process. They're off and running, doing very, very well, exceeding our expectations on both the ROIC and the sales and margin. But what you'll see is these open sight lines, this sort of more residential feel. The sight lines being brought down, actually a curation of the assortment, about 20 to 30% less product in the store than there was traditionally, and a celebration of great national brands and our own brands that differentiate and create exclusivity. So I think better lighting, better freshness, better ease, and this sense of discovery again at Bed Bath & Beyond.
Can you get enough workers to work on this store? I mean, this is a 2-level store.
Yes.
There's a lot of different shops. How many people work in here, and how have you been able to find the talent?
Yeah, about 350 people work here on rotation. We have been able to find staff here. I think we've pulled from all our best talent across the business, as well as we've recruited brand new talent. Look, people are still passionate about working in retail and working in a great environment, and this is a beautiful environment to work in. But where companies focus a lot on being people-powered and how do we invest in team members and their experiences as well as their benefits. And I think just creating a community for our associates that they can believe in and belong to has been really important. So yeah, we have the team.
Welcome back. Crypto And the sector as a whole has a new reason to celebrate when it comes to enthusiasm for the space. And one company in particular has 900 million reasons to celebrate. The largest ever private crypto funding round coming for FTX, the crypto exchange led by Sam Bankman-Fried, that now sees its valuation up to $18 billion, a far cry from the $1.2 billion valuation it had just about a year ago. And for more on the deal, I want to bring on the CEO and co-founder of FTX, Sam Bankman-Fried, joins us once again. And Sam, appreciate you coming on here, man. I mean, you attracted money from a lot of big name investors, SoftBank, Sequoia, Coinbase Ventures, Paul Tudor Jones, even getting in on the deal, plus a lot of others. 900 million is a lot of money. I mean, what are you looking to do with it now that you have it? Because FTX has already been growing.
Bigger yachts. No. You know, we're in a fortunate position where we are profitable, and that is, you know, even sort of through the various endorsement deals that we've been doing. And so the primary thing that we're looking at with the funds is basically, you know, M&A. There are a lot of companies that we think, you know, we could do a lot with, and you know, some of those might be on the more expensive side. And this will give us a ton of flexibility on that front.
Yeah, I mean, when it comes to M&A, I wonder what looks most attractive to you for growth. If FTX is already growing rather quickly, we're showing the exchange volumes there per month on the screen. But when you look at what looks most exciting to you, what is it you'd want to add to FTX?
Yeah, so I think that there's two pieces of this. One is when you just look at the user base. I mean, we're, you know, really happy with the growth that we have in the product we've built. We're also late to the game as far as crypto exchanges go. A lot of them had tens of millions of users before we turned on. And so any ways that we can really get our product out there in front of a lot of users, I think has huge value to us. And so I think that's one piece of this, you know, products that already have very large user bases. I think another piece, in some cases, from a licensing perspective, it can be useful. That depends. It doesn't make sense in all cases, but there are some where it can work and be quite valuable. And you know, we're aiming to be as licensed as we can be, as you know, as an exchange. And then the third thing is, I think there are cases where our products are very synergistic. You know, we can easily add crypto trading and payments, on ramps, off ramps, wallet services, to basically any product or application. And so anything that would, you know, that is sort of in desperate need of that, I think would be a really attractive company to be working with.
As you think about how to expand what you offer right now, I mean, to your point, you were a little late to the game when you compare it to your competitors. I mean, who do you consider your biggest competition right now?
Yeah, so I think it depends on which jurisdictions and products you're looking at. You know, I think if you look in the States right now, obviously Coinbase is going to be the first name that everyone says. After that, you know, Kraken. And then you have players like Paxos, which are on sort of more of the licensing and white labeling and back-end provider front. But, you know, you also have players like Robinhood, which are on the sort of consumer side and flexing into crypto. When you look internationally, you know, I mean, I think that we're something like the fourth biggest by volume today of exchanges, and you know, it's Binance is the biggest by far. You know, they're the biggest competitor globally. And then you have you know, Huobi OKEX. We're probably the largest exchange outside of China. But you know, we're still, you know, 5% or so of the market share globally, maybe 6% now. There's a lot of room to grow there.
You might have some people looking at it and scratching their heads and wondering, you know, obviously you still maintain majority control of the company here, and you look at, you know, raising 900 million and the pressure it adds. I mean, if you got 60 investors now to answer to, was there ever any idea here that you might not want to go that route, especially if, I mean, you know, how profitable the company is? If you wanted to go that route or wanted to maintain independence, and I guess what it sets up for the public road of FTX and what you're thinking on that front when it comes to what seems like, you know, you have this whole aura of doing things your own way.
Yeah, there's a bunch to unpack there. So one thing I'll say is, like, why bother doing this in the first place? And the capital for acquisitions, I think, is a piece of it, but another piece is just building out partners and allies. We have a lot of those in the core crypto ecosystem. We've had a lot of really great interactions with core players over the last few years. We have a lot less of that when you venture outside of crypto, and we're trying to build that out. And I think this round was a key piece of accomplishing that. So I think that's sort of the impetus for it. And then when you look at, you bring up what I think is an incredibly important point of, can the company still be able to function in a nimble way? And I think the answer is yes. And, I'll be frank, that's how this was designed, and that's how this round was designed. This was not a round where I was selling out of the company, taking a back seat, and it was going to be sort of, governance by committee. This is, we're going to continue charging forward in the same ways we have been, except hopefully with more ammo behind us as a company. And that sort of is something that's been explicit to everyone in this round. We're really excited to have them as partners and advisors. But this is not a thing where there's going to be 60 votes on every product tweak that we're going to be looking to make.
You've had, obviously, one of your competitors, Coinbase, come to market. There's a lot of people who are looking to your company to say, well, what's next in terms of a potential listing? You've made no secret about those ambitions, but you've been able to raise so much money on the private side. And I wonder what the incentive is. How attractive do the public markets look for you right now?
Yeah, mixed. I think, we still see significant upside in it. I think in terms of especially the exposure we get, how easy it would be to form partnerships with companies. I think those are huge upsides. As you said, the liquidity for the equity is not the biggest concern for us. It is fairly liquid in private markets as is, and we don't need to raise a lot more. And so I think it would be less from that perspective. And then on the, why not do it? It's a hassle. It's like, I think sort of we're coming back at you and thinking like, I don't know, we could roll out these 4 products, or we could try and go public. I don't know, which is better for the business, right? And maybe being a little bit glib there. And there's more going on than that, but that really is a lot of it. I don't know what the right answer is, but what we're sort of trying to do is position ourselves that we can do it if we want. We're, in terms of getting audited, in terms of obviously raising this round, put together a board, things like that. We want to be in a position where we can seize the moment if it feels like the right thing to do for the company, but where we don't have any pressure to go public if it doesn't seem like it's the right thing for the company. And, I don't know how this is going to play out, but we're working to keep our options open.
I guess, keeping your options open is a good thing. That's one way of measuring success, I suppose. But I am curious, just to kind of wrap up here, what success looks like to you now after already leading the largest round in crypto. What you are going to use as, I guess, your mark for success moving forward. Is it going to be kind of acquiring one of these major competitors out there now that you have this stash of cash, or is it going to be one of those white label deals that you're talking about to really cement FTX in that space? I mean, what is it that you're going to use, maybe the biggest measure of success in the year to come?
Becoming twice as big as whenever you ask me that question. I could give you an answer right now, but I very intentionally update those goalposts as we grow, because they're arbitrary, right? There's always more. There's always a better job that we can be doing. There's always more products. There's always more licenses. There's always more users, and there's always a better experience for everyone involved that we could be creating. I don't think we are anywhere close to being close to running out of opportunities or ways to improve. And any sort of like benchmarks we set for ourselves, they're going to be arbitrary, and the goal will be to blow past them and then create a new benchmark. I don't have a point in my mind where I'm like, yeah, once we get there, let's half-ass it. That seems like you would plan. No, that's not how we're thinking about this.
Yeah, I wouldn't expect that from a company that just went from 1.2 billion in valuation to 18 billion in a year's time, but also wouldn't expect it from Sam Bankman-Fried. Appreciate you coming back on here to chat with us again, man. Congrats on the deal, and we'll be chatting soon. Be well.
We got to get back to earnings here. Back to the bread and butter. Snap and Twitter both out with numbers that beat estimates, as we talked about earlier. Snap shares trading at a record following robust numbers as well this morning. Both of those companies seeing subscriber growth, but Snap in particular also seeing better monetization of that subscriber growth, and both companies seeing fairly robust ad sales as well. Jason Helfstein is with us now. He's Oppenheimer Managing Director and Senior Analyst. Jason, it's good to see you. Let's start with Snap here and the growth that the company is seeing. And how are you thinking about them, sort of the transition to reopening? I see Snap as a company that people still use kind of when they walk around just to text, even if they aren't posting the same kinds of things on Snap that they were doing before.
Yeah, I mean, look, just numbers real quick. They added 12 million users in the quarter. That was less than first quarter 16. So you could argue maybe the reopening kind of had them adding less users, but it was 3 million above where they guided. They did make a point of talking about they think with the reopening, you potentially get less kind of user-generated content created. And so as opposed to Spotlight, which is kind of more of the, the kind of semi-professional, right, of kind of influencer content. So look, definitely in the narrative, but I think the more important thing here is that they really are dialed into what the advertisers are looking for. And as, again, brands feel comfortable about the economy, are launching new products, they are looking at Snapchat as a key platform for them, and especially going to the kind of all-important, back to school holiday season, it looks like Snap is incredibly well positioned and kind of leading with these augmented reality and kind of next generation advertising.
And Jason, thinking about Snap's place within the online ad ecosystem, is this a story of Snap gaining share within that, or is it just that Snap continues to offer such a compelling platform on its own that it's bringing in spend even if its share relative to a Facebook or a Google isn't climbing at a rapid rate?
Yeah, no, they're definitely gaining share. I mean, they were up, their revenue was up 116%. I don't think any other company in digital media will see that much revenue growth in the quarter. I mean, Twitter was up, which we'll talk about in a minute, was up 74. I think people expect, again, kind of Facebook and Alphabet to be strong, but not nearly those levels. So no, they are, on paper, they are gaining share. And then kind of you talk to advertisers, they are gaining share of mind with the products that they're talking about. And again, a lot of what they're talking to advertisers about, no one's really spending money on yet, like, virtual try-on ads and, but people see where this could potentially go. And so, right now they've kind of having the best of both worlds, which is that on paper they're gaining share, and the enthusiasm around what they're doing. And then look, I mean, we all sit around thinking about, well, we don't sit around, but when we think about these companies, we're always thinking about like, what is like the next leg of growth? Like, is there another business, another vertical that has not been factored into the model that you'd say if they did X, it would be worth Y, and the stock is not as expensive as it appears on paper. And so now there's a whole discussion of like the metaverse, right? And you report on kind of what's going on in the gaming space and Roblox and all that, and Mark Zuckerberg has talked about it in this idea of like, could Snapchat be a player in the metaverse? Well, what they're doing with augmented reality, they have the audience, maybe, right? And so those things just get Wall Street really excited.
Jason, what's this better stock to own, Twitter or Snap?
I mean, from here, it's easier to say you'll make more money in Twitter. Snap, expectations are sky high. I honestly think people are surprised that the stock is up this much. I mean, if you talk to, institutional investors, they expected a very big quarter and very big guidance. And honestly, while the guidance is great for the third quarter, guiding to kind of 59% revenue growth at the midpoint, call it 60. Most of the institutional investors were expecting that. So I actually think you could see much more positive surprise in Twitter over the next 12 to 18 months than Snapchat from a kind of financial standpoint.
And so maybe moving, staying on Twitter, but moving away from the financials specifically and thinking about the product pipeline that we've seen from Twitter over the last, quarter. They called out in the letter, they've got ticketed spaces, they've got super follows. Now, as an analyst covering the company, how does that product cadence, animate anything for you? Does it make you think differently maybe about, how management's running that business?
I mean, a few things, right? So the whole issue that Twitter had historically was it was too hard to use. So people went to Twitter and then they didn't go back because they didn't know what to follow. It's too confusing. And so I think topics is huge. It makes it much easier for new users. They talked about adding 2,500 new topics. They're now at 9,500 topics across 9 languages. They're doing, they had 175,000 new city locations. So they're now, and kind of cited the benefits of that. And so I think you're just seeing kind of better kind of engagement with, the new incremental users. And then the idea around the Olympics, there will be a lot of people who come to Twitter who probably have not been on Twitter in 2 years, right? Since the last Olympics or maybe some sporting event, some championship sporting event or something. And to the extent that Twitter is a better experience now than perhaps the last time they were there for a major event, that increases the likelihood of repeat activity. And so I think that's really where it all comes together. I mean, yes, it'd be terrific if they can get the subscription product out. And to your point, tip jar, ticketed spaces, super followers, all that. But, at the end of the day, Wall Street is very focused on, DAU growth and revenue per DAU. And so, that's the output, right? So it looks like, for the first time in a while, Twitter is really doing the right things. And, look, we are in a very momentum-oriented stock market. So you could understand, why Snapchat is seeing the kind of activity it's seeing today in the stock. But I think kind of as the dust settles out, I think you'll get investors kind of looking at Twitter, and some people may have not invested in Twitter in a while coming back and saying, okay, this is becoming much more investable.
Hey, Jason, just one last quick one on Bitcoin, which is something that Dorsey was asked about on the call. And obviously, he's really leaned into Bitcoin and his other business, Square. It's a more natural fit. And he sort of talked about Bitcoin for Twitter, but it's unclear to me what exactly it brings to the table. Do you think there is an opportunity here for him to sort of integrate it more into the Twitter business also in some way?
I mean, look, I think he's trying to be, supportive of Bitcoin to the extent that he's trying to figure out real business applications for it. I mean, to the extent that, payments or virtual gifting becomes more prevalent in Twitter, technically you could accept Bitcoin, but I kind of don't see Twitter becoming a Bitcoin play anytime soon.
Gotcha. One of the few things, I guess, that he's touched that it maybe isn't as much. Jason Helfstein, thank you. Oppenheimer Managing Director and Senior Analyst joining us there to chat what's going on with Bitcoin.
Crocs is riding a wave of momentum for its trademark clogs and sandals this summer, and it once again played out in a big way in the company's latest earnings report. Crocs said this week that second quarter sales surged more than 93%. Operating profits more than tripled. Joining us for a dive into the world of Crocs is CEO Andrew Rees. Andrew, good to see you again. It's been a while. Take us through these results. How long could these types of growth rates, nearly 100% in terms of sales, how long could this continue?
Look, I think we are confident that we can continue to have very strong growth. We've had sort of 4 consecutive quarters of really extraordinary growth as we've emerged from the pandemic, as the consumer is back out shopping both online and in store. We guided to the rest of this year to the full year being 60 to 65% growth. Look, there are some quarters, like particularly the second quarter, where you are seeing a trough in the compare numbers, but we are confident that we will continue to grow, very strongly into the future. Really driven by the brand momentum. The brand has very strong momentum. It's connected very strongly with consumers, particularly younger consumers. And we have a big market potential that we can go after, both here in the US and also in the rest of the world.
Andrew, give us 3 reasons why this momentum in the business. Why are you seeing a new generation of Crocs wearers emerge? What's driving them to the stores?
Yeah, that's a really great way of thinking about it. So number one is the core DNA of the brand. So it's comfortable, it's easy on and off, it's lightweight, so it's very easy to wear, and it appeals to that major comfort trend that's going on. Number two, we add a great deal of excitement and inspiration to the brand through the collaborations, which you see on the wall behind me, through all of the social media marketing that we do, and we really engage our consumers, and we make it a fun brand to participate in. And our brand values are very compelling for those younger consumers. We also announced just recently net zero carbon emissions by 2030, which is very important to that consumer group. We're a great value, right? So, our typical shoe costs about $50. We're not asking people to mortgage their firstborn to buy a pair of our shoes. And in fact, we really want the question to be when somebody's shopping is how many colors am I going to buy versus which one am I going to buy? And then I think thirdly, is the international nature of the brand. We are already in 90 countries around the world, so we're penetrating into those markets, but we have a lot of runway for growth in many of those markets.
Hey, Andrew, it's Julie here. The first reason you mentioned is why my kids are devotees of Crocs. They're comfortable, they're easy to put on and take off, etc. I do have a question about price, though, because my kids are 9 and 12. I've been shopping for Crocs since they were walking effectively. And maybe you view them as a good value at $50 a pair, but for quickly growing feet and for someone who's been buying them for a while, the price has definitely gone up over the years, and not just in the past year that we've seen inflation. Are you seeing any kind of resistance to price increases on the part of consumers?
No. In a word, but obviously let me correct a couple of things. So the adult price is $50, the kids price is much less, obviously, because it's a smaller shoe. And as you pointed out, they only last so long. But one actually wonderful thing about Crocs is they do last a long time. And so part of our sustainability efforts is we're actually looking at re-commerce and reuse. So that would actually be ideal for those kids' shoes. We want to encourage people to find a next home and a next life for their shoes, and we'll be providing some vehicles to do that. But your core question in terms of price resistance, we really have not found any price resistance. We look very carefully at price. We think a core value of our brand is the democratic nature of the brand. We want it to appeal to a very broad range of people, and it does. And we don't want to make sure that we never have price as an obstacle to that. So we do look at that very closely. But also from an investor perspective, we want to make sure that we're capturing the value that the brand deserves, and we're able to return that to our investors.
And Andrew, staying on kids, you guys talked about it a little bit on the call, but we're on the leading edge of it, and maybe we don't have a full read, but certainly back to school is going to be an interesting time for all retailers as we hope to head into a normal school year. What are you guys seeing there? And maybe another way of asking, was there also a stock up into the summer season, which for most of the U.S. at least is going to be a little more friendly to daily Croc wear than the winter months?
Yeah, we certainly. So let me take the second piece of that first. Yes, we certainly saw a stock up into the summer season. We saw some of our, I would say kind of resort type of locations, so places where people particularly will drive to go on vacation, whether it be, the Panhandle or Myrtle Beach, et cetera. We saw really strong performance in those kind of places as people were desperate to go somewhere and desperate to also consume and shop and go out when they were in those kind of locations. So I think there was a stock up into the summer period. And also aided by stimulus, right? As we go into back to school, we are seeing, very strong reads on back to school. We think back to school will be strong across the board, but I think particularly strong for Crocs. And it's been a really important part of our growth story is actually de-seasonalizing the business, building a much stronger back to school business, and building a much stronger fourth quarter business. And we've done that and taken a lot of seasonality out of the business.
Andrew, what's your next big partnership?
So we have a ton of them, right? So the collaborations that we do, the partnerships that we have are really, really important to our brand. You can see some of them on the wall behind me, and they could be everything from KFC. We recently did Balenciaga, which was our second collaboration with Balenciaga, the high fashion brand. But we also did in the last quarter, we did Nongshim, which is a famous South Korean noodle brand. So we do a wide variety. And major celebrities. I think you've got Bad Bunny up there on the screen. I would say we have a significant number of collaborations planned for the remainder of this year and into next year, as diverse and as exciting as the examples I've just given, but we're really careful about not revealing those ahead of time.
I've got my eye on the spiky pink ones over your shoulder there, Andrew. Sorry to come back to price, but I want to ask another question related to that, which is about input prices and whether your guys are going to continue to raise prices. I imagine oil, one of your major input prices, oil prices have been on the rise. What's that going to do to margins for you guys, and are you going to continue to raise prices of the shoes?
Yeah, look, I think we believe that we are in an inflationary environment, right? So I think we've seen that in the numbers, and we think that will sustain for some period of time. That costs are going to rise. It's less, frankly, around oil, and it's more around labor and transportation. So you could say that some of the component of the transportation was oil, but the input, the raw material that goes into our shoes is oil derived. But that's really a very small part of the cost. The biggest part of the cost is the labor that goes into making it, the labor that goes into selling it and distributing it, et cetera. And so the cost pressures that we're seeing are really labor costs, and I would say transportation costs, so global logistics, so container rates, outbound shipping, those costs are all rising. But we're not changing our pricing to reflect cost, right? We're looking at our pricing from a market-based perspective. We're looking at it based on competitive pricing. So where are our competitors? What are the sensible alternatives that the consumer has? And what we think represents a really good value for the amount of design and equity that we put into the shoes.
I think I'm with you, Julie. I like those spiky shoes behind Andrew. Maybe in black, not in pink, but I kind of dig them.
We have both.
All right, we'll leave it there. Crocs CEO Andrew Rees, always good to see you. Good luck this quarter.